And I'm going to start with the question that we've heard the most. And by the most, I mean from the largest number of clients and also from for the most amount of time, meaning we've been hearing it all through the year and also a bit last year too. And that question is, are we in a recession? Are we headed for a recession? Do we think the Fed might be able to navigate this, soft landing that everyone's so skeptical of? And certainly, this is a nuanced question, but to get us started, I'm going to pass the mic over to Jason for him to share his thoughts.
Thanks, Liz, and thanks everyone for joining this morning. It's always great to get the opportunity to be in front of as many people as possible to talk about these important issues. And just diving straight into the question about whether we're in recession right now, the short answer is no, we are not in recession currently. We can look across a number of the best indicators. And Liz, you talked about a couple of them. We have a strong consumer. We have a strong labor market. We added 1.6 million jobs so far this year after adding 4.5 million jobs in 2022. So the economy is fully employed and people are out there still spending money. We still have about a half a trillion in terms of stimulus, COVID stimulus that sits in folks' bank accounts, which has helped buttress the consumer as well. If you look at the unemployment rate, and we actually lean on a current indicator called the SOM rule, which does a pretty good job of determining whether or not we're currently in a recession. It's a way of looking at unemployment as a reflection of whether or not the economy is still expanding or whether it's contracting. And by that measure, we are still firmly in an expansion. So we're not in recession yet. But unfortunately, our view continues to be that the odds of a recession over the near term, let's call it over the next 6 months, 12 months, obviously the timing is difficult to predict. Just getting the recession call correct is difficult enough, but the timing can be harder still. You know, our view is that recession is, like I said, likely. And we say that for a variety of reasons, despite the fact that the consumer is still strong, despite the fact that we still have a fully employed economy. There are a number of leading economic indicators that we like to pay attention to that we think have done a really good job. If you look at, you know, a long arc of economic history, a long arc of economic cycles, these indicators have done a fairly good job of being ahead of the direction of the business cycle. And unfortunately, the preponderance of those leading indicators suggests that the odds of recession look elevated right now. And just to hit on a couple of those, the Treasury yield curve is a good leading indicator for the economy. And right now, the Treasury yield curve is deeply inverted, meaning that short-term rates are higher than long-term rates, which impacts bank lending, which can impact economic activity and economic growth. One of our preferred indicators, the Conference Board's leading economic index, which is also referred to as LEI, which is a index of 10 subcomponents that are also leading indicators, is around 9% off of its cycle highs. And in every instance going back 60, 70 years, that indicator has led recession by about a year, and it's been in contractionary phase for about 12 months now. So again, as we're looking at kind of our dashboard of what we think reflects, the path of the economy going forward, while things right now look steady, there's a decent chance that we're going to continue to see a deceleration in the economy, which could lead to us tipping in recession. And why is that? That's because of what the Fed's been doing primarily. We had normalization post-pandemic that was already slowing the economic trajectory down. But as Liz mentioned in her opening remarks, the Fed has been pretty aggressive over the last 14 months with monetary policy, the most aggressive since the Volcker era in the 1980s. They've taken interest rates from 0% to north of 5% in a very short period of time. That type of monetary policy has long and variable lags, as economists like to say, which means that it takes time to filter into the real economy. So we still think there's some slowing to come because of what we've seen with monetary policy.